Now, adjustment number 9. The directors recommend that 1. Provision should be made for both investment income due and debenture interest due. So let's deal with that now. And as you can see, investment income, as we had worked out earlier, was 8,100. Minus already accounted for was 4,500. Remember, that was for the 5 months. So the investment income due at the end of the year is 3,600. So investment income is a gain to us. So it's a gain to the company. So we credit investment income 3,600 in the profit and loss account, and we debit investment income due in the balance sheet 3,600. It becomes a current asset. Now the debenture interest, the debentures now, at the end of the year we had debentures of 300,000. We had 240,000 at 7% for 12 months. We had 60,000 of a debenture at 7% for 9 months. And that gave us a 19,950. That should be in the P&L. Now, we have accounted for 4,200 already. That 4,200 was the 6,400 already in the trial balance, minus the reduction of 2,200. You remember the correction that we did? And that gave me the 4,200. So debenture interest due is 15,750. So we go to the profit and loss account. So we debit debenture interest. In the profit and loss account, 15750. We'll add that to our 4,200, and that will give us the 19,000 odd that we had calculated. And we credit debenture interest due in the balance sheet, 15750. It becomes a current liability. The next thing then, so that's fine, and that's that sorted. Now we then look at the next adjustment. And this was somewhat provision for bad debts to be adjusted to 4% of debtors. So let's see what our debtors were. Our debtors in the trial balance was 98,200. And then we had to adjust it for the 7,500. Do you remember that was the sale or return? And then there was the bounce check. And then there was the 1680 that we received and the bad debt. So that left us with a new debtors figure of 90700 at 4%. So we said the provision for bad debts at the end of the year should be 3628. However, already accounted for in the trial balance is 4,000. That leaves us with a reduction in bad debts. So that's a gain to us. So it's going to be credit bad debts, credit reduction in bad debts in the profit and loss account, 372. Debit provision for bad debts in the balance sheet, 372. So that reduces the provision from 4,000 to 4,000 minus 372. The next one then, and this was tricky. The managing director should be paid a bonus of 5% on all sales in excess of 1.2 million. And that's fine. So we get the sales figure from the trial balance, which is 1590 minus the 7,500. That was the sale or return, giving us 1582500 minus 1.2 gave us the excess was 382,500 at 5%, which is 19,125. And that 19,125 is cost, a debit commission in the profit and loss account, 19,125. Credit commission due in the balance sheet, 19,125. And the last adjustment that we had to do, and there was no workings on this, was to transfer 10,000. The last thing it told us was to transfer 10,000 from the profit to the capital reserve. So what we had to do there is debit the profit and loss account, down at the end 10,000, credit capital reserve in the balance sheet 10,000. And that is the end of our adjustments. We then have to proceed with the trading profit and loss account and balance sheet.